Welcome to FXTech's comprehensive AUD USD analysis for November 10th through 15th, 2025. This week brought significant developments that reshaped market expectations for both the Australian dollar and US dollar. We'll examine the historic US government shutdown resolution, strong Australian employment data, shifting central bank policy expectations, and critical technical levels. Our analysis covers short-term trading ranges and medium-term scenarios with specific probability assessments. Whether you're a day trader or position trader, this report provides actionable insights backed by data from TradingView, ActionForex, Forex.com, and Daily Forex. We'll break down the key drivers, identify critical support and resistance levels, and outline risk management strategies for navigating elevated volatility. Let's dive into what moved AUD USD this week and what traders should watch in the coming days and weeks. The November 10 to 15th period was characterized by strong Australian economic data, conflicting with global uncertainty. Australian employment figures dramatically exceeded expectations, with 42,200 jobs added versus the 20,000 forecast. The unemployment rate fell to 4.3%, reinforcing the Reserve Bank of Australia's hawkish stance. This positive domestic data initially pushed AUD USD higher, but gains proved difficult to sustain. The pair traded in a volatile range between 0.6520 and 0.6570, reflecting the tension between Australian strength and global headwinds. The US government shutdown resolution brought relief, but also uncertainty about the coming data deluge. Meanwhile, Federal Reserve officials signaled that rate cuts are far from guaranteed, causing market expectations to shift dramatically. Chinese economic concerns continued to weigh on sentiment, limiting AUD upside despite the strong employment report. This created a complex trading environment, requiring careful risk management. Australian employment data for October delivered a powerful upside surprise that reshaped RBA policy expectations. The economy added 42,200 jobs, more than double the 20,000 consensus forecast. Even more impressive, full-time employment surged by 51,600 positions, demonstrating genuine labor market strength rather than part-time job growth. The unemployment rate fell to 4.3% from 4.4%, while the participation rate held steady at 67.2%. Indicating the job gains weren't driven by people leaving the workforce. This combination of metrics suggests genuine economic resilience. The immediate market reaction was bullish for AUD, with the currency spiking higher on the release. However, gains proved difficult to sustain as traders weighed the positive domestic data against global headwinds. The strong employment figures dramatically reduced expectations for RBA rate cuts, with some analysts now suggesting the next move could be a rate hike rather than a cut. After weeks of disruption, the historic U.S. government shutdown finally concluded during this period, clearing the way for economic data releases to resume. However, rather than providing relief, the resolution created a new challenge, an unprecedented information vacuum. For weeks, critical economic indicators, including employment reports, inflation data, and GDP figures, were delayed, leaving investors operating with incomplete information about the true state of the U.S. economy. This built up a significant backlog of reports that will flood markets in coming weeks. Rather than sparking a relief rally, the reopening brought little immediate comfort to markets. Investors remained cautious and unwilling to make significant directional commitments until the backlog of economic data provides a clearer picture. This hesitation reflected concerns about what the delayed data might reveal about economic conditions during the shutdown period. Following the shutdown resolution, U.S. assets struggled across the board. Equities came under pressure as investors reassessed Fed policy and valuations. Treasury yields moved higher but offered no support to the U.S. dollar, which weakened broadly despite fading Fed easing expectations. Safe haven flows failed to materialize in any meaningful way. In currency markets, USD weakness during the early week provided some support for AUD USD. However, deteriorating risk sentiment limited sustained gains for risk-sensitive currencies like the Australian dollar. Market positioning appeared cautious rather than bearish, with traders stepping aside before the data storm hits. Looking ahead, with government operations resumed, the pipeline of U.S. economic releases is about to restart. After several weeks of silence, the impact could be amplified. Volatility is likely to climb as markets digest a heavy flow of indicators that will reset expectations for both growth and inflation. Federal Reserve policy expectations underwent a dramatic transformation during this period. Market-implied odds of a rate cut in the next meeting collapsed from 94.2% just 1 month ago to only 44.4%. This stunning reversal reflects a series of hawkish signals from Fed officials. Multiple policymakers emphasized that rate cuts are far from guaranteed, pushing back against market expectations for aggressive easing. The shift occurred despite mixed economic data, suggesting the Fed is prioritizing inflation concerns over growth risks. Fed Chair Powell's recent comments reinforce the message that the central bank will remain data-dependent and patient. This hawkish pivot has significant implications for AUD/USD. Historically, a hawkish Fed supports the US dollar, creating headwinds for AUD. However, if the RBA maintains its own hawkish stance while the Fed delays cuts, the interest rate differential could actually favor AUD over time. The coming weeks will be critical as delayed US data reveals the true state of the economy. From a technical perspective, AUD/USD remains in a consolidation phase with well-defined support and resistance levels. The pair is trading above the critical 0.6520 support level, which represents the November low and a key structural support zone. Immediate resistance sits at 0.6570, which has capped multiple rally attempts this week. A decisive break above 0.6570 would open the door to 0.6600, a psychologically important level and the upper boundary of the current range. On the downside, support is layered at 0.6520, 0.6500, a major psychological level, and 0.6460, the 200-day moving average. The technical structure suggests a neutral to slightly bullish bias as long as the pair holds above 0.6520. However, momentum indicators show limited conviction, reflecting the fundamental uncertainty. The 50-day moving average is converging with price, suggesting a potential breakout in either direction is approaching. Traders should watch for a decisive break of the 0.6500 to 0.6600 range to establish directional conviction. For the next 1 to 2 weeks, we maintain a neutral to slightly bullish bias for AUD/USD. The expected trading range is 0.6500 to 0.6600, with the pair likely to remain range-bound as markets await the flood of delayed U.S. economic data. The short-term outlook reflects the tension between positive Australian domestic data and ongoing concerns about global growth, particularly in China, as well as uncertainty surrounding U.S. economic data releases and Federal Reserve policy. The strong employment figures provide a fundamental foundation for AUD strength, but the inability to sustain gains above 0.6570 suggests that upside momentum is limited in the near term. Traders should focus on range trading strategies, buying near support at 0.6520, 0.6530, with initial targets at 0.6570 and extended targets at 0.6600. Stop losses should be placed below 0.6500 to limit downside risk. Given elevated volatility, position sizes should be reduced to 50 to 75% of typical allocation. Key catalysts to monitor include delayed U.S. economic data releases such as retail sales and industrial production, which will create heightened volatility as markets digest weeks of accumulated information. RBA and Federal Reserve official commentary will be critical in shaping interest rate differential expectations. Any hawkish RBA rhetoric or dovish Fed signals could support AUD/USD, while the opposite would weigh on the pair. China economic indicators, including manufacturing PMI and industrial production, will directly impact AUD sentiment given Australia's export dependence on Chinese demand. Global risk sentiment shifts and equity market performance should also be monitored closely, as AUD is a high beta currency sensitive to risk appetite. Critical risk management guidelines include reducing position sizes to 50 to 75% of typical allocation, tightening stops ahead of major data releases, avoiding overtrading in choppy conditions, and being prepared for sharp intraday moves. High volatility is expected from the data deluge, so consider using option strategies to limit downside risk. Looking at the medium-term outlook for the next 1 to 3 months, we see two distinct scenarios. The bullish scenario, which we assign a 55% probability, targets 0.6650 to 0.6800. This scenario would be driven by sustained Australian economic resilience, a dovish Fed pivot, and China economic stabilization or improvement. The trigger would be a decisive break above 0.6600, followed by sustained trading above this level. Policy-wise, this scenario assumes the RBA maintains its hawkish stance while the Fed begins cutting rates more aggressively, favoring the AUD interest rate differential. The bearish scenario, with 45% probability, targets 0.6200 to 0.6400. Drivers would include China economic slowdown, global risk-off flows, and stronger than expected U.S. economic data. The trigger would be a break below 0.6500, then decline through 0.6460, the 200-day moving average. AUD's high beta characteristics make it vulnerable in a risk-off environment, especially with global recession fears or geopolitical tensions. The critical pivot level for the medium-term outlook is 0.6550. This level has emerged as the key determinant for directional bias over the coming 1 to 3 months. Sustained trading above 0.6550 favors the bullish scenario with 55% probability, targeting the 0.6650 to 0.6800 range. This would confirm underlying strength and support continuation toward higher levels. Conversely, a decisive break below 0.6550 shifts the balance toward the bearish outlook with 45% probability, targeting the 0.6200 to 0.6400 range. This would signal loss of momentum and potential trend reversal. Risk management considerations are critical given elevated uncertainty from delayed U.S. data releases and China economic outlook. Markets will remain volatile as the backlog of economic information is digested. Traders should reduce leverage compared to typical positioning, considering 50 to 75% of normal position sizes to manage risk exposure. Use wider stop losses than typical to account for increased volatility, placing stops beyond key technical levels to avoid being stopped out by normal market noise. Several risk factors could significantly impact AUD/USD in the coming weeks. Australian domestic risks include labor market volatility, as monthly data is subject to significant revisions, housing market cooling in major metropolitan areas, inflation persistence creating an RBA policy dilemma, and consumer confidence vulnerable to property market downturn. U.S. economic and policy risks encompass data deluge uncertainty from the backlog of delayed economic reports, Federal Reserve policy error, whether too hawkish or too dovish, political tensions and potential future government shutdowns, and fiscal policy disputes weighing on confidence in U.S. assets. China economic risks remain a major concern, including growth slowdown more severe than anticipated, property sector stress with major developers in distress, policy response inadequacy or ineffective stimulus measures, and weak manufacturing PMI with sluggish industrial activity. Global risk factors include geopolitical tensions escalation, financial market instability with potential Sell America theme reemergence, commodity price volatility affecting AUD as a commodity currency, and technology sector correction with significant wealth destruction. Maintaining strict trading discipline is essential in this environment. Position sizing should be reduced to 50 to 75% of typical allocation given elevated volatility and uncertainty. This allows participation while limiting exposure to unexpected moves. Stop-loss discipline requires placing stops beyond key technical levels, not arbitrary percentages. This approach avoids being stopped out by normal noise while limiting losses if the narrative shifts. Profit-taking strategy should involve taking partial profits at key resistance levels rather than holding for maximum gains. This locks in profits while maintaining upside exposure. News risk management is critical. Close positions, reduce size, or use options ahead of major data releases, as sharp, unexpected moves are likely during the delayed report period. Correlation awareness means monitoring Chinese equities, commodity prices like iron ore and copper, and U.S. Treasury yields. Divergences provide early warning signals. Avoid overtrading by focusing on high-probability setups with clear risk-reward ratios. Resist the temptation to capture every short-term move. Most critically, fundamental awareness is essential, as technically perfect setups can be invalidated by unexpected news during this period. Let's summarize the key takeaways from this analysis. Australian employment data exceeded expectations across all metrics, with 42,200 jobs added versus 20,000 forecast, and unemployment falling to 4.3%. This strong data dramatically reduced RBA rate cut expectations, with some analysts now suggesting the next move could be a rate hike rather than a cut. The U.S. government shutdown ended, but brings a data flood and elevated volatility in coming weeks as markets digest the backlog of delayed reports. Fed rate cut odds collapsed from 94.2% to 44.4% in 1 month, as officials signal easing is far from guaranteed. This hawkish shift creates a complex backdrop for AUD/USD. The technical structure remains constructive above 0.6520 support, but global uncertainties limit sustained upside. The interplay between strong Australian fundamentals and global headwinds creates a challenging but potentially rewarding trading environment for those who manage risk carefully and remain disciplined in their approach. Our trading recommendations are as follows. For the short term, covering the next 1 to 2 weeks, we expect AUD/USD to remain range-bound between 0.6500 and 0.6600, with a neutral to slightly bullish bias. This range trading environment favors buying near support and selling near resistance, with tight risk management. For the medium term, covering the next 1 to 3 months, we maintain a cautiously bullish outlook targeting 0.6650 to 0.6800, with a 55% probability. This scenario assumes sustained Australian economic resilience and a dovish Fed pivot. Critical support levels to watch are 0.6550, which is the key pivot level for medium-term direction, 0.6520, the November low and immediate support, and 0.6500, a major psychological level. Critical resistance levels include 0.6570, which has capped recent rally attempts, 0.6600, the upper boundary of the current range and a psychological level, and 0.6650, the first target in the bullish medium-term scenario. These levels provide a clear framework for risk management and position sizing. Thank you for watching this FXTech analysis.